Good afternoon, traders. Welcome to Master Trader's educational option webinar on selling credit spreads for reliable weekly and monthly cash flow. I'm Dan Gibby, the Chief Options Strategist, and I'm very excited to be here with you today to share with you the Master Trader strategy on selling high probability credit spreads around the charts with ease. So let's begin. Some benefits of attending today. I don't care what type of trader or investor you are, or if you have a money manager, the power of selling these credit spreads is going to help you generate more profits, period. I'm going to show you today not only the why, but how for you to begin trading these high probability strategies. It's just going to turbocharge your returns versus trading stocks alone. I'm going to show you how to generate this passive income, and it doesn't take a lot of time. That's the beautiful thing. We have some of our credit spread masters who it merely takes them 15 minutes of preparation from the comfort of their own living room on the weekend, and they're off golfing or retired or have a full-time job. So stick around also to get all of this in-depth information on this strategy. And then at the end, I'm also going to share a gift with you to help get you started on this exciting strategy. Here's how we're going to tackle today's information. We're going to show you how our edge is in selling these options with the chart pattern. If there's no bias, no compelling pattern, then there's no trade. And I'm also going to show you and demystify the incorrect belief that charts don't work, they don't have any predictive power. There's some option traders out there who they just trade off the numbers, or the Greeks, if you will, and they get run over by the directional going against them. I'm going to give you a number of examples here today. Just typical bullish and bearish turning points, climactic patterns, which we've had a lot of recently in this market sell-off, high volatility news stocks. You know, companies, whether it's earnings or they're pasted on the front of the media, their volatility skyrockets, and that provides tremendous opportunity to us. I'm going to show you how to do that. I'm going to show you how you can sell option spreads both before and after earnings. And then I'm going to show you how you can trade the index, like the spiders, the diamonds, the Qs, IWM, and volatility ETFs after sell-offs. Some of our traders actually make a living at just this one strategy right here. They go about their daily life, they wait for the markets to sell off, and then they get ready to strike. They collect their money, they enter the trade, they manage it, and they're off waiting for the next setup. And I'm going to show you that there's been a few of those opportunities just in the last couple of months. And then I'll show you how the risks of selling options without charts and how you can use the charts just to get a superior confidence level in the trade working out. A little bit about me. I've been in the markets for over 25 years and learned technical analysis through my business partner and good friend, Greg Capra. And he's the master at technical analysis. And so I've done that and portfolio management, but my slant has always been from option trading. And that's because I find it so much easier. So it's my comfort zone. And as I'm going to show you, and you're going to see for yourself, that you have a cushion to be wrong. And that's one of my favorite sayings, where in my customers also, we say, wow, we stopped out of a trade that went against us and we still made money. So there's nothing practically you can't throw at me that I haven't seen before. So learn from my mistakes. If you want to master these credit spreads, you're taking the very first prudent step right now, or whether you have already, you're still going to learn more today, because even if you've heard me talk about this subject before, or a current subscriber of ours in the green room, for example, our live trading room, repetition is the mother of skill. I've managed an option layover program, and what that means is we take other people's inventory and we make them superior by overlaying option strategies around it. I've done it for a global proprietary trading firm, hedge funds, high net worth individuals. You see me there on the boat. I'm actually a licensed captain, private pilot. I have a pretty impressive resume, none of which helps me be a successful trader, other than maybe actually being a pilot. And the reason I say that is they have very similar beneficial skill sets in terms of we analyze objectively the material, we react to our instruments, and we manage in between unemotionally. That's what it takes to be a good trader. And also, I love worldwide travel. So I can take my Dell laptop. I've been to over 60 countries. What I'm showing you today, ladies and gentlemen, is genuinely, hopefully, if you listen to the material and follow what I'm going to show you, it should change your life. You can put on this strategy and these trades that I'm going to be sharing with you here anywhere in the world on your laptop, as long as the market's open and you have an internet connection. That is a wonderful sense of confidence, of freedom to be your own boss, and joy, of course. Greg and I actually love what we do. So whatever, again, type of trader you are, our methodology and teachings can make it better and help you develop your own trading plan so you know what to objectively do, instead of just following the masses, the media, the fear, the greed, or even some vendor trying to sell you some magical oscillator, which he's just trying to sell you a product that doesn't work. So Greg and I formed Master Trader, and what we do, we trade ourselves very aggressively. We consult, we teach, and we're very good at what we do. So you are in the right place today. Just our obligatory disclaimer. I mean, it's so common sense that whenever you venture into a speculative activity, we put our money on the line with the intent and goal to generate a return on capital. So we have to put risk capital on the line. But as you're going to see here today, the probability of success with this credit spread options strategy is overwhelming. So let's continue. Just a couple high-level points of our approach to shorting options and these credit spreads. Our goal is to earn this continuous income by selling options, because buyers of options have to pay money for those contracts, and the value of them expires day by day. That time decay is our profit potential. If you buy a stock, you're only going to profit if it moves in the intended direction, whether you're long or short. This strategy, we are getting paid just for predicting where a stock will not go. And that is the phenomenal aspect of this strategy. I'm going to show you through these many examples exactly how to do it, step by step, with many chart patterns, which is our edge. We don't have to time entries with precision. See, when we buy or short a stock, that's what we call a directional strategy, where we want multiple time frames to be in agreement, and then we want a big target. So we're precise on our entries. In this strategy, you're going to see, and you'll hear me say over and over again, not only in this webinar, but if you're in our green room, that you'll hear us say, I wouldn't buy that stock, but it looks like a tradable bottom, and we're going to sell a credit spread to get paid for that. We like high volatility. Volatility is a measure of market risk, market fear through the SIBO volatility index. So when volatility is high, fear is high, and that translates into high put premiums, high put and call premiums. And when we sell those credit spreads around the charts, we are getting paid handsomely for that trade. Once we're in a trade, we're in trade management mode. And we aren't going to be talking about that in detail today just because of time limitations. But this is how Master Trader manages trades. We can either do nothing because it's going to expire worthless, or we don't mind being assigned the stock because it's by definition going to be at an improved cost basis. We stop out if the pattern is ruined, and there's some option traders who say, oh, don't ever take a stop, just roll in perpetuity. We don't believe in that. We enter and manage based upon charts and volatility. So we will stop out. This strategy of ours here has an 85% plus success rate. I didn't say 100. We do take stop losses and minor losses, but it's all about managing the 85% winners and the 15% or less losers, and then the math takes care of itself. We have adjusting strategies, hedging, we'll roll if it makes sense. But the beautiful thing is, bull markets, bear markets, choppy markets, summer doldrums, whatever the case, Greg and I can find compelling trades. Well, he finds them, he's the scanning master, but then we work together to put them through my option filter, and we can come up with a compelling trade, I promise you, in 30 seconds or less. He and I working together. It's an amazing combination. Just a visual here on what time decay is before we get into the examples. Now, this is called theta. It's one of the Greeks, so to speak, but don't even worry about the title. I just want you to worry about concepts. So I mentioned that when buyers buy options, that costs money, just like when you buy an insurance policy from your insurance company. Theta measures the rate that extrinsic value loses, it evaporates per day. And what this graph is showing you is that as time to expiration gets closer to the expiration of that call or put contract, the time decay rapidly expires. This is a picture of why Master Trader specializes in selling credit spreads 45 days or less, but we even love doing them 10 days or less, because you see here the last 30 days, it's falling off a cliff. 10 days, it's falling off a steeper cliff. And that's why we gave birth to a new product called our weekly options trader. And that is 100% focused on selling the credit spreads that I'm going to be sharing with you today. 10 days or less expiration, days to expiration. So this is a great product for the weekly paycheck. 85% of options expire worthless. So we want to be on the selling side of that, the other side of these options that are expiring worthless to the option buyer. So again, time decay hurts buyers, it helps sellers. Rapidly into expiration, and there you go with the charts. A little bit of more definition here, just in case you're new to options, to put it in perspective for you. So who buys options? A buyer pays money for the right to either buy stock or sell stock within a specified amount of time. That's what buying calls and puts means to the buyer. They do that because they think the stock is going to move in their intended direction, and they don't have to pay a lot of money to speculate in that directional bet. And then if they're correct, they get a higher return on capital. That's ROC. Now, Master Trader does buy options also for directional patterns, but we do it intelligently. And I'm not talking about buying options today, so I can't get into it, but we do it where we still stack the odds in our favor, even greater than trading stock. Sellers of options, that's us today in this webinar. We are receiving money and we have an obligation for that money that we're receiving, either to buy or sell the underlying within a specified time. And this is what we call an income trade. And we're just getting paid to predict short-term turning points. And that's why our magical combination is selling credit spreads with the charts, because we have a bias. We want these options to expire worthless, which is above support if we have a put spread, or below resistance if we have a call spread, and I'll show you examples. And then the money that we sold is 100% profit. It is a beautiful thing. It's by definition, it's a higher probability of profit versus trading the stocks alone. Now, one caveat to that, it's less potential gain. Our gain when we're selling options is always the credit received. So I'm not saying buying stocks isn't a good thing. Just make sure multiple timeframes are in alignment. And Master Trader, of course, we buy stock, and we also have bullish option directional trades. This is a picture of what we call Master Trader bullish money patterns. Every one of these are different flavors of bullish turning points. Now, of course, how bullish I am is going to depend on many things beyond the scope of this webinar, because I'm not here teaching you, a chart analysis course. But these are all bullish pictures. Where they are in the daily, weekly, and monthly chart would tell me how bullish I was. But for today's discussion, here's what we're doing. Under support, I'm going to be selling a put option. I'm going to simultaneously, in one order sent to your broker, and this is what's called a bull put credit spread, I'm going to buy an out of the money put. Why do I do that? For two reasons. Number one, limits the capital required for me to put on the trade, the maintenance requirement. Number two, if I have a disaster gap against me, I limit my risk. The difference of the put that I'm selling and the put that I'm buying is going to be a credit. It's money going into my pocket. That credit is our potential maximum gain. But remember, once we enter a trade, we're always in management mode. Sure, we hold many trades and let them expire 100% worthless, but proper risk management, we are taking partial profits all along the way. Now let's jump into the fun part, now that we have that foundation stuff out of the way. Here's just a nice bull put credit spread that we put in our weekly options trader. And this is an example of a stock I would not buy. There's signs of bottoming here. It's a sell-off to major support. I have the 200 period moving average there. And there's an ugly wide range bar here, followed by a bottoming tail, which is a sign of strength, signs of buying. I would not buy the stock, but I would put my money on the line, meaning my capital required, my maintenance requirement to call a short-term bottom. Remember I told you we like high volatility because we get paid more for the put we're selling? Implied volatility rank is just ranking the volatility of this stock. This one's NUE between 0 and 100. Higher the better. So when we're selling options, we want them high. The stock sold off at this particular time in February. The whole market was selling off. So here's what we did. We mark our line under support. We sell a $59 put. We're buying an out of the money 55.5 put. That's called a bull put credit spread. 5 days to expiration. We're selling it for 45 cents a share. So in this webinar, I'm going to assume a 10 lot. What that means is because one option contract represents 100 shares of stock, then selling a 10 lot is like 1,000 shares. So a 10 lot on this, $450 would immediately be deposited into my brokerage account. I would have an obligation to buy the stock at $59 a share if the put buyer wanted me to. But remember, we're picking patterns where there's a high probability of profit that it's not going lower. And that's using master trader strategies, master trader technical strategies. I'm going to be showing you the return on capital of all these because I don't want you to sit back and say, well, Dan, all right, that's $450, but that's not going to pay for my condo rent or my boat gas, whatever the case. We have many of these going on at the same time, high probability of profit, and let's look at the return on capital. Your brokerage firm, the capital required to put these spreads on is the spread width. So that's $3.50. But you already put 45 cents a share in your pocket. So you divide those two out, 14.7% return on capital. Folks, I'll let you do the math. This is 5 days of risk. If you annualize that, it's off the charts. It's crazy. Look at this now. This is what the stock did. So you can see that 5 days later, this $59 put expired, totally worthless, $450, pure profit. Now this one performed beyond my expectation. I wouldn't have expected this, but it doesn't matter. I was just predicting a short-term bottom and getting paid day by day for time decay. Another example. This is what we call a master trader climactic buy setup. Just count all these red bars. There's a bunch of them. Then an ugly gap down. I like keeping things simple. So do you like that word? It's ugly. It's an ugly gap down. But look to the left. There's major support. What happened during this day? The gap was negated and it engulfed this bar. Then it consolidated 2 more bars, upper 50%. These are all things you would learn in Greg Capra's amazing Master Trader Technical Strategies course. 2-bar pullback, 50% of the top range of this bar, bottoming tail, range expansion, price void. These are all technical terms. Pick up in volume, 200 period moving average. The odds of this bottom holding, look, we shorted the $45 put. I have blocked in red here. 45 bought the further out of the money $40 put. Look what happened to this one. Blasted. Now this one actually, even though I'm not talking about directional trades today, because of what I just reviewed, we actually gave not only an income trade, we gave a bullish option directional trade. So just because I'm collecting $500 on calling a 5-day bottom, you know, this, you know, Greg's the guilty one at this. And I don't talk like this, but we are meaning the same thing. Greg would look at this pattern and say, Dan, that's free money. Once it trades over the high of this range expansion bar, the odds of it holding this base in 5 days is free money. And I would say, well, I just personally don't use the word free money because it's not free. And here's why. Greg is saying free because of his staggeringly high confidence rate. But guess what, folks? You aren't just born with confidence. You don't just say, I want to start trading and can pick up and repeat everything I just said about the bullishness of this pattern. That comes from proper education and seasoning. That's why he's saying it's free money, because it is a no-brainer setup. And actually, just so I don't forget, write this down because I can't write on here. Dropbox is another no-brainer put spread, in our opinion, that we just found into the market close today. It's Dropbox. The symbol is Delta Bravo X-ray, DBX, is that right? Delta, just look it up. Dropbox. We sold the 22 days to expiration. The out of the money $30 puts, we bought a $25 puts, took in 55 cents a share, and just go, I didn't have time to make a chart because we just did it at market close. But that one's great. Also, yeah, just check it out. Another example, high volatility trade. This is a continuation pattern. It's built up a base of support, even though it took out this prior low. It's healed itself. Wide range bar that closed above this, nice little inside bar. Volatility was 100%. We sold the way out of the money $40 puts. And when volatility is high, we have the luxury of selling further out of the money. And when you hear me use the term cushion, again, it's in the vernacular, but that's referring to the distance out of the money from where the stock is trading. The stock's trading at $49 and change. And we're putting money in our pocket, and our legal obligation is to buy the stock at $40 a share. That would be a 20% discount. I mean, folks, whether you're doing it now or you're going to do it in the next 5, 10, 15 minutes, you really should be salivating over the opportunity of these, because you should be thinking, oh my God, this is too good to be true. Then we bought the out of the money $35 put to limit risk and capital, 55 cents a share, 29 days of risk, another 550 bucks, 12.3%, 18.7% cushion. So if I'm required, meaning if the put buyer wants me to buy it at 40, I've already put 55 cents in my pocket, my break even 39.45. But folks, when would the put buyer make me buy it at 40? Answer, only if it's trading under 40, because otherwise he's better off selling it in the open market. It's worthless. And that's what's considered out of the money. As long as the stock is greater than my short put, it's out of the money. And that's what we do at Master Trader. We use patterns, and we're selling one out of the money put, buying a further out of the money put, and then we just manage in between. All right, well, this poor guy's not having a good day or week or month. This is just a beautiful pattern of bearish option trades. Again, I'm not teaching you chart analysis today, but this pattern, declining 20, declining 50. I mean, I could teach a whole technical strategies course on this one page of the bearishness of everything going on here. So you want to short every breakdown and every failed rally into resistance. We would be shorting our out of the money bearish credit spreads, putting money in our pocket at every point. Now let's move on to talk about the scenario where, whatever the reason, I don't care what it is, you're in the heat of the battle, not you, the stock. When this happened just a couple months ago, when Steve Wynn got in trouble for his shenanigans, the stock tanked 205, down here to 160. And I like referring to this as, we're just going to wait for the storm to pass. That's what I call this trade. We will be trading you because volatility is off the chart. I'm going to get paid handsomely. And the charts don't lie. The charts tell us when selling has eased and when demand, which is synonymous for buying, is taken over because of selling exhaustion. This gap down, this is pre-market, and then when the market opened, it just ripped up. That's bullish. In our green room, we're trading live, and we're talking live, giving trades live, answering questions live. And so we were watching this trade together, even pre-market. We start at 9 a.m. Eastern with our market analysis, we come up with our game plan, we come up with our interest list, we come up with our gap list, and this was on our gap list for the day. So this is pre-market activity right here. We had a higher high, higher low. It ripped out of the open. So right here, we sold our put spread and got paid hugely for it. Then through the midday doldrums, we call them, we added on this breakout. No fear, no looking at the news, just reading, like the pilot I mentioned. We're reading the objective data that's before our eyes. Once we're in the trade, we're in trade management mode. It's really that simple. And then we just do it over and over again, day by day, whatever one of the 61 countries I might be in that day. And we are going to teach you the skills to do this on your own. Another example, this was pre-earnings. Now, typically, we at Master Trader don't like shorting options into earnings. Why? For the obvious reason of gap risk. We don't want the gap risk. We prefer waiting for the gap the following day and then trading it within the first hour if it sets up the way we want it. Remember, everything is set up, action, manage. Set up, action, manage. Just because we have a setup doesn't mean we have action, because it didn't fully set up on the intraday time frame. We were prepared, but it didn't do what we wanted. This one, we made an exception. We have bullish. Look, I have multiple levels of support. The implied volatility was 100%, and that's because of pending earnings. The stock's at 45 and change. We sold the $30 puts, $15 away, and we still bought a $25 put to make it a $5 wide spread, 9 days of risk, 45 cents a share. Folks, if I sent you a marketing email that said, please come visit us today, I'm going to show you how you can make, make whatever the return is on this one, 10% per trade, and the stock can go 34% against you. If I were to receive an email like that, I would hit the delete button so fast, because it would be unbelievable. But that's what I'm sharing with you today. We do these all the time. Yes, you had higher risk because of the earnings. I get that. But your worst case downside, your break even is the same as your cost basis. If you're required to buy this at 30 bucks, you already put 45 cents a share in your pocket. That's your break even. That's your cost basis. 34% cushion. Allstate, what do we have going on here? This is post earnings now. We did this in our weekly options trader. Something we teach, professional gap. So that happened on earnings. Cleared this multi-month trading range. Pro gap we define as is a bullish gap which ignites a new move. This was one of them. So we actually did a directional trade and an income trade on this. But we traded it in the green room, but then we gave it to our the weekly options trader on this, what we call a bullish 1, 2, 3 continuation pattern. And what that is a bullish inside day in the top range of this big bullish fat green bar. Over the high of that is where you enter. We sold the out of the money 97.5 puts, bought the $95 puts, so that's a $2.50 wide, took in 57 cents a share. There's another 570 bucks, and return on your capital. Capital, again, the amount of money your broker is holding aside while this position is still open. 29.5%. This is one of my favorites. This, we didn't do it this day. We wait until it got more oversold. But February here, and this is this year, the SPY is the ETF for the S&P 500 index. So we trade this all the time. When the spiders get way oversold, so this strategy that I'm going to show you right now, we did it here, but then we did it again. And this is the strategy that I told you. We have some subscribers, this is all they do. They might only trade 4 or 5 times a year. This is the setup they're looking for. Oversold, like a mini crash. They're looking for way oversold on the spiders. Why? Because the volatility skyrockets, and then we can sell way out of the money puts and get paid even if the stock goes way against us. You don't do it here when it's a falling knife. You wait till you get a reversal bar. So that's what we do. We're looking at the SPY, the volatility index, and our market internals, which give us heads up on major turns in the market, which Greg will teach you all about in the Master Trader Technical Strategies course. Then when this sets up, we do 2 trades. We're selling out of the money put spreads on the spiders. And this little guy down here is the VXX. That is the ETF for volatility, the SIBO Volatility Index, VIX. But the VIX, you cannot trade. It's just a computer measuring the 30-day implied volatilities of S&P options. You can't trade it, so you need either an ETF, you need the VIX futures, or you need VIX options. And I have a whole specialty 4-hour course that will make you a master at volatility if that interests you. Just check it out on our website. But we're waiting for the VIX ETF to reach very high levels and reverse at major resistance. And then we're selling an out-of-the-money call spread on those. I told you we love selling 45-day and less options. I then told you we love selling 10 days or less. We also sell expiring options 9, 8, 7, 6, 5, 4, 3, 2, 1, even 0 days to expiration. We sell options with 2 hours to expiration. Why? Because we're applying the same methodology that we've been talking about together, but the premium more rapidly goes to 0, genuinely like a melting ice cube. So let's look at Boeing here. It got very extended. Then we had a wide range, what we call, a wide range bar after a big multi-bar move far from the 20 moving average, typically ends a move. You don't just jump into it, you wait for a reversal, but the very next day, we got that reversal. Look at this 15-minute chart. Solid selling deep into this bar. So if you are a skilled technician, like our graduates are, all we're doing is saying, hey, I don't think Boeing is going to make a new high on the day. Income trade. Here's our 350 resistance. We sold the 350 call, bought a $10 higher 360 call, took in 48 cents a share on a 10 lot, 480 bucks. Premium will rapidly become worthless if it ain't going back higher. It's our melting ice cube. Return on capital for 1 day, folks. I mean, again, I wouldn't even venture to tell you this because you wouldn't believe it. But look at that, it's 5% return on capital for 1 day. Here's our melting ice cube. 2 hours later, we closed half the trade. Remember I told you we're in trade management mode once we enter. And then we move stop break even on the back half. Now, some of that was because of time decay, but the other part was because the stock continued to fall. So when the stock moves in our intended direction, we're also making money on these short credit spreads because of what's called delta. It's moving in our direction. And then when we sell high volatility options, like I've been showing you, we also make a lot of money just from volatility contraction. We have some folks, I told you, that like to sit in their nice air-conditioned living room on a Sunday afternoon after they're done reading the paper. They get some iced tea and they do the following. It takes them 15 minutes. So I don't ever, I mean, it's a good question, but I'm answering it right now. If somebody says, I don't have time for this. And we actually do have some people that just say, I do have time for it, but I don't want to do it. I want to pay you guys to give me the trades. And of course, I mean, we can either teach you how to fish, or we can give you the results of Greg and my homework and recommendations of best high probability setups. And we want you to, profit along with us. But here, let's talk about this strategy. All it is, and it could be the spiders, Qs, diamonds, IWM, but spiders are liquid, spiders and Qs. Here's what you do. You're waiting for any bullish setup or even sideways consolidation. We're going to sell our out of the money put credit spread. This one client of ours, he just does it $5 wide every time. It's just routine. You just mark off the prior pivot low, which is major support. There you go. You sell a 30-day out or less, days to expiration, put spread, manage in between. Another breakout here, do it again. Another breakout there, do it again. Here actually was our bear call credit spread. This topping tail was a false breakout. So under the low, short, you're out of the money, bear call credit spread. Every one of those examples would have expired 100% maximum profit. And again, that is our edge. Master trader patterns with option strategies. And today I'm just going over these credit spreads as an income. And in our full option strategy series for investors and traders, it's a complete 10 module. I get into every imaginable option trade. Let's now look at, I get emails all the time. Even our subscribers send me newsletters and say, hey, I just got this trade recommendation from XYZ. What do you think? And so these two examples I'm going to show you came to my inbox via that method. So United Airlines here, they were recommending a bullish option trade on this doji bar. To master trader, and you can go back and look at that slide where I said master trader bullish money patterns, and this is one of them. This is what we call a bullish W bottom. It's a retest. And we even like the retest when this makes a lower low. We like it even better. So that was a crazy place to enter a bullish option trade. We wouldn't do it. But now, once I have, and it's not picture perfect, but it's the same flavor. This bottoming tail was an ugly red bar, closed with a bottoming tail, then another green bar held a higher low. Over the high of this green bar, now I'm ready to sell my put spread. You see the difference? I mean, it's just, I remember telling this subscriber that. I said, I don't know if this is going to hold, but I told him if it fails, I said it's going down to this next level of major support. I mean, I'm not a magician. It's just what the charts suggest. Another one here. I mean, this guy, I got an email right here. I don't even know if this guy reads charts. I really don't. I don't care what their method is. But, you know, in the green room, there's this one service that is so bad. I've been watching them for like a month and a half. And we review his trades together every day. And of a month and a half, I'm not lying to you because I don't do that. There's not one single trade I've agreed with him. Not a single one. And it's just crazy that the junk that people put out there. So this competitor on this day, this doji bar, this is a professional gap down, attempted rally, topping tail, ugly red bar, gap down, doji bar. Like, are you crazy? I wouldn't touch this thing bullish. Now I have a big bottoming tail. Now I have a big green, deep, wide range bar. Now I have a bottoming tail which made a higher low than these two. That's my first place. I wouldn't buy the stock, but I would sell a 210, 200 put spread. This star, I would do it again. This star, I would do it again. But you see the difference of these three stars versus this one? I've built a base of support. These are signs of buyers telling me that if I sell a 210 put, the odds of it expiring worthless are very high. Now I'm just gonna go through these quick because with the recent market sell-off, these were all trades that we gave to our subscribers. And these are all bear call credit spreads. So all I'm doing, just so we can go through them quicker, I'm showing you the pattern, and the arrows are pointing to the places that we would sell an out of the money bear call credit spread. This gap down, and Greg Capra, to our subscribers on this red, or it was either this bar or this red bar, but he was sending out alarm bells to our subscribers. Danger, danger, danger. The sentiment reached such a high bullish level that we use that as a contrarian indicator, and that's telling us that that's going to put a cap on this market and likely lower prices. And of course, we get many thank you letters, you know, for that. So on the gap down day, we sold an out of the money bear call credit spread, then came in, lower high, it's a mess, gap down again, did it again. We sold an out of the money call spread above the high of this little guy. XLU, it's strong. I mean, it is very, very bullish move from the low to the high, but there's my 200 period moving average. I have a topping tail at major resistance on the daily and weekly charts. We drop down to our 15-minute time frame and in the green room, and then I sent out an alert to our subscribers. Right here, right on the breakdown is our intraday entry, and then we go back to the daily to manage. Nvidia here, kind of, we call this a breakout failure. Came down, couldn't rally back up, wide range engulfing. We sold an out of the money 270, 270 call, 275 bear call credit spread. ITA is the ETF for the defense and aerospace. It's been on a tear since the Trump election because of, you know, his obvious wanting to rebuild and spend money on the military. but charts don't lie. Look at this weekly chart. Resistance, 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 resistance. That's the weekly. Then we drop down to the daily and we sold our out of the money bear call credit spread. If you don't use charts in your option trading, you're flying blind. It is somebody just trading on the Greeks. I don't know what they would do. They're like, oh, premiums are high. Let me sell a put spread. Well, it's a bearish pattern, number one. But why would you want to sell a put spread when the likelihood of this getting through this resistance is staggeringly low of it getting through it? So that was another nice profitable trade of ours. Las Vegas Sands, again, a breakout failure here. Consolidation is creating resistance, small gap igniting right in the morning, right as this bar was forming. We sold a call spread. OKTA, ugly red bar here, 50% retracement. Started rolling over, seller out of the money call spread. LH, just a nice little double top, taking out a prior low. So this is the opposite of the W formation. This is an M formation. So it broke its higher high, higher lows. And all we're doing is calling a short-term top. GoDaddy, monthly. Look at this thing, ran from 35 bucks to 75, sideways. That was a bullish bar. That was a bullish bar. Engulfing, lower, gap down, under support, sell a call spread. And we have a consulting division where I mentioned to you the option layover, that our clients just give us their positions. And they're like, here, sell options around them. And this is what we do. When momentum stalls, we sell calls against their positions. And that just continuously lowers their cost basis. SPLK, another breakout failure, gap down, sideways, ugly red bar, sell a call spread. And do you see how these patterns, they're so clear to us? Again, because we've been doing this a while, but we can teach you how to read this and apply these credit spreads around the charts. MU, a weekly, just a big kind of double top, breakout failure there on that tail, red bar, topping tail. That was another no-brainer trade. So, I mean, you see how excited I get on this subject because I've been doing it for so long. They're easy to trade and manage, but let's address a couple points here that I've been asked in the past. And I want I definitely don't want to, if you are now salivating and say, oh my God, I want to learn more. Let's see if you have any questions on some of these. But is this strategy right for you? If you're just a buy and hold person and say, no, I'm not interested in that, then that's fine. But here's a couple other questions that I've had. Can I use this just on liquid ETFs to minimize gap risk? Of course. So we went over that with the spiders. Absolutely. And Master Trader actually has a new ETF trader that's geared for that purpose. That it's for the people who just want to outperform the broader market by focusing on the superior ETF components. And then we have option trading around that. And one huge benefit of trading ETFs is exactly what this person identified. There's much less gap risk because it's a basket of stocks. I have a full-time job, so I'm concerned about the time commitment. It's an excellent question, but I've also answered that if you want to just trade a couple ETFs, that's fine. If you want to create a trading universe of 10 stocks and you just flip through them on the weekend, then how much time does that take? For me to look at 10 stocks takes about 10 seconds. And then you just look up the credit spreads and see if you're getting an adequate return on capital. And then on Monday morning, you place the trade. So time is not a concern with this strategy. I only have a $5,000 account to get started in selling spreads. Is that enough? Yes. Remember, I defined for you what the capital requirement is. Let's say you have 5,000 bucks. A $5 wide spread, if you just sell one contract, and let's say you take in 50 cents on a $5 wide, then you're putting $50 in your account, because remember, one contract is 100 shares. So 100 times 50 cents a share is 50 bucks. Your broker's only going to withhold $450. So you actually could have 10 credit spreads open with a one lot. So absolutely 5,000 is plenty. And yeah, you want to start, paper trading, of course. You got to start and get the proper foundation. I've given you a phenomenal foundation today, but then you need a seminar, which I'm going to tell you about in a second. And then you need paper trade, and then start off with a small contract size. Does it make sense to risk such a large potential loss in spreads for the limited gain? Excellent question. So let me answer that. On a $5 wide spread, your maximum loss, if you have a disaster gap against you, is the spread width less the credit received. But you cannot go into these thinking, oh my God, I can make 500 bucks on this, but I could lose 4,500. Here is the proper way to analyze that. What is the probability of success? That's number one. Number two, what is the likely stop out if it hits my protective stop on the charts? Because remember, all these patterns, we're putting the stop under support or over resistance. The answer is, in our experience, it's no more than 2x the premium received. So if you're taking in 500 bucks, just budget for contract size calculation that if you stop out, you're going to lose 1,000. But you already put 500 in your pocket, so you're really only losing 500. But even be more conservative, say 3 to 1. So I want you to assume worst case scenario, again, other than a disaster gap, if the stock gets bought out or gaps up $40, then you're going to feel some pain. But that's similar to the insurance company having to pay for a house that burned down. See, we're similar in selling credit spreads. We're just like the casino in Vegas, and we're like the insurance company. We're continuously bankrolling these small premiums. And yes, every now and then you will have to make a payout. But are the insurance companies profitable? Are the casinos profitable? You better believe it. We just have to worry about managing intelligently our losses, and we do that with the charts. So even if you assumed a 3 to 1 and you lose $1,000 if you get stopped out for making 500, you can do the math on your own. But 85% of the time I'm making 500 bucks, and only 15% of the time I'm losing a worst case 1,000. You have a positive sloping P&L curve there. All right, let me finish with this phenomenal description of this mastery course I just finished, literally just a few weeks ago, and it took me over a year to put this course together. It's 14 detailed modules. You've got a taste of it today. You're going to learn, again, the patterns that we just touched upon today. getting paid where the stock's not going to go, monthly income, high probability. We're going to get into managing them and adjusting strategies, trade management, 14 separate modules, specialty topics. I mentioned trading the volatility index. I have a module on that. How to trade earnings, gaps, news, ETFs, trading on expiration day, etc. So if this is not for you, if one of those questions that I mentioned, then I appreciate you spending some time with us today to keep an open mind to see if it was for you. But if you're serious about wanting to make money with this high probability strategies of ours, then spend $397. Check this out, mastertrader.com/mastering spreads. And as a bonus for you attending today and signing up, I'm going to give you a special video on what's called offensive adjusting strategies. What that means, we're in a trade, it's working as intended, and I want to make more money on it. That's what we call an offensive adjustment. Plus, we're going to offer a bonus group coaching. So that is going to conclude my presentation. I hope you found that very valuable. Feel free to email me, dan@mastertrader.com, or my business partner, greg@mastertrader.com, for any questions, but even, in particular, the technical analysis course. You can try us out, take a 21-day trial to our Master Trader advisory letter, and our weekly options trader that I mentioned, which you will get trades almost every day that are the output of this strategy, a mere $39 a month. So again, thank you for coming today. I hope I enlightened you or extended your current understanding of this strategy, and we wish you the very best of success in your trading. Take care, everyone, and see you next time.